Australia's gross government debt has crossed the $1 trillion mark. For traders, it's a data point. For households, an abstraction. But inside the budget, it triggers a different reality, where interest costs begin to crowd out hospitals, schools, and disaster recovery funds. This wasn't an accident. It was the culmination of an average increase of $50 billion every year for nearly 2 decades. The government had simply spent more than it earned. The world has changed since 2022. The era of near-zero interest rates is over. An aging population and slowing productivity growth mean the economy can no longer outrun the compounding cost of debt. The real story isn't the number itself, it's the trigger. What policy choice becomes non-negotiable when the interest bill breaches a specific fiscal line? We're going to map the forced decisions ahead, the trade-offs between taxes, spending, inflation, and growth. And we'll answer the final question: does Australia take the hard medicine now or attempt to inflate the problem away? Crossing the trillion-dollar threshold changes the budget's fundamental architecture. Interest as an expense transforms from a background cost into a standalone government program, and one of the largest. It will soon eclipse entire portfolios. This immediately narrows the government's flexibility. Every new dollar of spending, whether for aged care or defense, now directly competes with the non-negotiable cost of servicing past decisions. The mechanics are slow but relentless. As older, cheaper debt matures, it must be refinanced at today's higher rates. The weighted average interest rate on the entire debt pile climbs with a lag. This creates a fiscal drag that operates on autopilot. The risk hiding in plain sight is that every 1 percentage point increase in borrowing rates adds billions to the annual interest bill. This is automatic austerity, imposed without a parliamentary vote. The pressure points are already visible. The structural deficit, the NDIS's exponential growth, the demands of aged care, the planned defense uplift, and the escalating cost of natural disaster relief. Each now fights for oxygen against a debt service cost that must be paid first. This is the triage debate that begins in earnest. Do you freeze public service headcount? Cap indexation for health and education programs below the rate of inflation? Or pause critical nation-building infrastructure? Each choice has immediate consequences for the real economy. This is where the abstract meets the concrete. Consider a typical household, let's call them Asha's family. They're already facing higher mortgage payments as their fixed-rate loan resets, and bracket creep is pulling more of their income into higher tax brackets. Before the government announces a single cut, their disposable income is eroding. Then add the state government's response. They'll likely increase fees and charges to manage their own fiscal pressures. The household's financial resilience is being hollowed out from multiple directions, all traceable back to that trillion-dollar figure. Meanwhile, the ratings agencies and bond markets are watching. Australia's prized AAA credit rating hinges on a credible plan for budget consolidation. A weak plan, or worse, no plan, would push what's called the term premium higher. Investors would demand more compensation for the perceived risk, creating a feedback loop. Higher borrowing costs lead to larger deficits, which lead to even higher borrowing costs. The room for error shrinks dramatically. While Treasury officials model these scenarios, Australian politics is about to collide with simple arithmetic. The menu of politically palatable options narrows to a few forced choices. The debate is no longer about grand visions for the country. It's about which essential service gets less funding so the interest bill can be paid. The moment the line is crossed, fiscal management becomes a defensive game. The government's primary objective shifts from building for the future to managing an escalating liability from the past. This is the new reality that defines policy for the next decade. The trillion-dollar mark isn't a milestone to be celebrated. It's a fiscal tripwire that has now been triggered. The arithmetic of $1 trillion in debt forces a brutal simplification of policy. The government can no longer pretend to address every demand. It must choose from a narrow menu of options, each with a distinct set of winners and losers. The constraint is clear. You can attempt to pick two paths: revenue, restraint, inflation, or growth. But pretending to pick none is what got us here, and continuing that illusion will only accelerate the rise in borrowing costs. The first forced choice is to raise more revenue. This isn't necessarily about increasing headline income tax rates, which are politically toxic. It's about broadening the base. The most significant lever is addressing tax concessions, particularly the capital gains tax discount and negative gearing settings that have turned residential property into a financial investment vehicle rather than essential infrastructure. These tax expenditures represent a fiscal cost that dwarfs the savings from cutting entire government programs. Other targets include tightening the petroleum resource rent tax, implementing robust multinational profit-shifting rules, and the perennial debate about the GST base or rate. The impact of closing these concessions would be profound. It would likely redirect capital away from speculative housing investment and toward productive business investment. But the short-term risk is a correction in housing prices, which could dampen consumer confidence and economic activity. The second choice is to spend less. This is the path of fiscal restraint, but it manifests in ways that are often invisible until services degrade. The most common method is to cap indexation for key portfolios like health, education, and welfare below the rate of inflation. This creates a quiet, steady erosion of service capability. Fewer hospital beds per capita, larger school class sizes, and welfare payments that buy less each year. Another target is infrastructure. Projects facing significant cost blowouts become candidates for deferral, rescoping, or outright cancellation. This creates a direct trade-off between near-term budget relief and long-term productivity. The most difficult collision will be in defense, where the planned strategic uplift runs directly into the consolidation imperative. The government will be forced to choose: reallocate funds within the defense portfolio by cutting other capabilities, or push the budgets of health and education down even further to accommodate it. The third option is the most insidious: inflate the debt away. The strategy is to tolerate inflation running above the Reserve Bank's target band for a sustained period. This uses rising prices and nominal GDP growth to shrink the debt to GDP ratio. It's a stealth levy, effectively transferring wealth from savers and wage earners to the government. The constraint is the independence of the central bank. If markets perceive that the government is deliberately forcing the RBA to accommodate its debt, a scenario called fiscal dominance, Australia's risk premium would spike. The impact on households is direct and painful. The cost of groceries and rent would rise faster than wages, forcing families to bridge the gap with credit and widening inequality. The fourth and most desirable, yet most difficult choice is to grow out of the problem. This path focuses on a productivity revival that expands the economic pie faster than the debt accumulates. It involves long-term reforms to immigration quality, competition policy, housing supply, and the energy transition. It includes an industry policy focused on critical minerals and value-adding, though this carries the risk of subsidizing incumbents rather than fostering genuine innovation. Boosting labor participation through better childcare, training, and incentives for older workers also contributes. The impact of succeeding on this path is the best long-run outcome, restoring fiscal space without brutal cuts or tax hikes. But the gains are incremental and compound slowly. They offer weak near-term relief. Its credibility hinges on being paired with the harder choices of revenue or restraint. A plan that promises growth alone is a plan for higher debt. These aren't abstract theories. They are the direct consequences of the interest bill becoming the budget's primary stakeholder. For a household like Asha's, each path has a different face. Higher revenue might mean less ability to negatively gear an investment property. Spending restraint could mean longer waits for a specialist medical appointment. Inflation would silently erode her savings, and growth, if achieved, might not arrive in time to prevent her mortgage reset from consuming an unsustainable portion of her income. The government's selection from this menu will define the next decade of Australian living standards. The politics of this choice will immediately collide with the country's most sensitive economic nerve, the housing market. At the $1 trillion mark, the architecture of Australia's tax system comes under an unavoidable spotlight. For decades, policy settings have incentivized debt-fueled investment in existing housing stock. Negative gearing allows investors to deduct rental losses from their taxable income, while the capital gains tax discount means they pay tax on only half their profit if the asset is held for more than a year. This has made speculation more attractive than backing new businesses or technology. This tax architecture is now a central character in the debt drama. The concessions for property. Investors represent one of the largest untapped revenue sources in the budget. They are, in effect, a massive government expenditure program delivered through the tax code. When interest costs are consuming an ever larger share of revenue, these tax expenditures become impossible to ignore. Closing them represents a de facto tax increase without changing a single official tax rate, making it simultaneously attractive and politically perilous. The market sensitivity is extreme. Unwind these concessions too rapidly, and the housing market could experience a sharp correction as investor demand retreats. This would have knock-on effects for consumer confidence and bank stability. Yet doing nothing means the interest bill continues to cannibalize funding for services that all Australians rely on. The trade-off, once theoretical, is now explicit and immediate. The government must weigh the stability of an overheated housing market against the sustainability of its own budget. This dilemma is compounded by the banking sector's deep entanglement with housing. Australian banks hold a concentrated exposure to mortgages, meaning household balance sheets are directly tied to fiscal risk. Any policy shift that impacts housing prices or rental yields creates immediate spillover effects into financial stability. The bank's cost of funding is also linked to the government's credit rating through an implicit guarantee. If debt concerns lead to a ratings downgrade for the Commonwealth, the banks would face higher funding costs, which would inevitably be passed through to mortgage holders like Asha. The problem is further complicated by Australia's unique vertical fiscal imbalance. State governments rely heavily on stamp duty and land taxes, revenues directly tied to the health of the property market. Any federal policy that disrupts the housing model has direct consequences for state budgets, which are already under pressure. This makes a coherent national approach to fiscal consolidation incredibly difficult, as federal efforts to fix the budget could blow a hole in the state's finances. From the street-level view of Asha's family, these high-level conflicts translate into tangible pressure. They are renters facing a market with chronically tight supply. Any policy shock that reduces investor participation without a corresponding boom in new construction could exacerbate the rental shortage, leading to even higher rents. At the same time, the higher interest rates that stem from fiscal concerns are already flowing through to their cost of living. They are caught in a squeeze where the solutions to the national debt problem could directly worsen their personal financial situation. The housing model, long the engine of Australian wealth, has become a central point of vulnerability in the trillion-dollar reckoning. Even if the government finds the political will to reform these tax settings, the interest bill still arrives every quarter. The crisis then shifts from the immediate policy choice to the longer-term question of credibility. Can the government demonstrate a multi-year path to a primary surplus that markets will believe? The timeline for proving this is short, and the thresholds that trigger a market backlash are closer than they appear. The bond market doesn't wait for elections or political compromises. It reacts to data and perceived risk. Australia's window for managing this transition with some degree of control is still open, but it's narrowing with every budget update that fails to address the structural drivers of the deficit. The trillion-dollar line has been crossed, and now the countdown begins on the government's ability to convince investors that it has a credible plan to stop the next trillion from accumulating even faster. The market's patience isn't infinite. It watches specific thresholds. The interest expense to revenue ratio is key. When debt service consumes too large a share of tax income, flexibility vanishes. Another is net interest as a share of GDP. But the most immediate trigger is the maturity profile. Australia faces a refinancing cliff where large volumes of cheap debt from the past decade mature and must be rolled over at today's higher rates. This creates a sudden step-change increase in the annual cost. Credibility isn't built on budget projections. It's built on a legislated multi-year path back to primary balance. The political cycle is the greatest risk. Pre-election spending promises that widen the deficit will immediately be punished with higher bond yields. The window for action is still open, but it narrows with every quarter that service costs outpace nominal economic growth. The real trigger isn't a specific number, it's the loss of confidence that the political system can make hard choices. That trillion-dollar line forces choices that erode national illusions. The risk isn't a sudden default, but a slow, corrosive decline in public services and living standards driven by compounding interest. The real danger is delay. If you want to see which reforms could still steer Australia toward a sustainable path, watch our next analysis on the housing market's ultimate reckoning. Subscribe for evidence-based maps of the choices ahead.